Goldman Sachs, one of the world's leading investment banks, regularly updates its Treasury yield forecasts based on changing economic conditions. Treasury yields play a critical role in the global financial system, influencing interest rates, stock markets, and economic growth. When Goldman Sachs revises its projections, investors, policymakers, and financial analysts pay close attention, as these updates reflect the latest economic trends, inflation expectations, and Federal Reserve policies. Here are the top 10 factors that influence Goldman Sachs' revised Treasury yield forecasts. 1. Federal Reserve interest rate policy. The Federal Reserve's monetary policy is one of the biggest drivers of Treasury yields. When the Fed raises interest rates to combat inflation, bond yields typically rise. Conversely, when it lowers rates to stimulate economic growth, yields tend to fall. Goldman Sachs adjusts its Treasury yield forecasts based on the Fed's rate hike or rate cut expectations and statements from central bank officials. 2. Inflation trends and expectations. Inflation significantly impacts Treasury yields. When inflation rises, bond investors demand higher yields to compensate for the decreasing purchasing power of fixed income payments. If inflation cools, yields tend to decline. Goldman Sachs closely monitors Consumer Price Index (CPI) data, Producer Price Index (PPI) figures, and inflation expectations to adjust its yield forecasts accordingly. 3. U.S. economic growth projections. A strong economy typically leads to higher Treasury yields, while a slowing economy results in lower yields. When economic growth is robust, investors expect higher future interest rates, driving up yields. Conversely, weak growth pushes investors towards safe haven assets like treasuries, lowering yields. Goldman Sachs revises its forecasts based on indicators such as GDP growth, employment data, and consumer spending. 4. Global demand for U.S. treasuries. Foreign governments, institutions, and investors buy U.S. treasuries as a safe investment, influencing yields. Countries like China, Japan, and European nations hold large amounts of U.S. debt. If global demand for treasuries declines, yields will rise due to reduced buying pressure. On the other hand, strong demand keeps yields lower. Goldman Sachs analyzes foreign investment trends and central bank holdings when adjusting its yield outlook. 5. U.S. government debt and fiscal policies. The U.S. government's borrowing levels impact Treasury yields. If the government issues large amounts of debt to finance spending, bond prices may decline, causing yields to rise. Goldman Sachs considers federal deficit projections, debt ceiling negotiations, and government spending policies when forecasting Treasury yields. 6. Banking sector liquidity and credit conditions. Banks play a key role in the bond market. If bank liquidity is high, financial institutions may purchase more treasuries, keeping yields lower. However, if banks face credit tightening or lending restrictions, they may reduce their bond holdings, pushing yields higher. Goldman Sachs closely monitors credit conditions, banking regulations, and liquidity trends to refine its yield forecasts. 7. Stock market performance and investor sentiment. Treasury yields and stock market trends are often interconnected. When investors are optimistic about stocks, they may move funds away from bonds, raising yields. However, during periods of market volatility or economic uncertainty, investors flock to safe haven treasuries, pushing yields lower. Goldman Sachs evaluates stock market trends, corporate earnings, and investor risk appetite to make adjustments to its yield predictions. 8. Geopolitical events and market stability. Global events, such as trade tensions, wars, and financial crises, can cause rapid movements in Treasury yields. When geopolitical risks rise, investors seek safety in U.S. government bonds, lowering yields. However, if global risks fade, yields may rise as investors take on more risk. Goldman Sachs considers geopolitical risks, supply chain disruptions, and market volatility in its Treasury yield projections. 9. Federal Reserve's quantitative tightening or easing. The Federal Reserve has the power to buy or sell bonds in the open market through quantitative easing, QE, or quantitative tightening, QT. If the Fed purchases large amounts of treasuries, QE, bond prices rise and yields fall. If it reduces its balance sheet, QT, yields may increase. Goldman Sachs revises its forecasts based on the Fed's bond buying strategies and balance sheet policies. 10. Interest rate spreads and yield curve movements. The shape of the Treasury yield curve is a critical indicator of economic trends. An inverted yield curve, short-term rates higher than long-term rates, often signals a recession, while a steepening curve may indicate economic growth. Goldman Sachs studies yield spreads between 2-year, 10-year, and 30-year treasuries to refine its projections on future rate movements. Goldman Sachs' revised Treasury yield forecasts are based on a combination of economic data, inflation trends, Federal Reserve policies, global demand, and investor sentiment. By closely analyzing these factors, the firm provides insights that help investors navigate the complex bond market. As the U.S. economy evolves and global financial conditions change, Goldman Sachs will continue to adjust its yield forecasts to reflect the latest market realities.